All right, well, we are going to go ahead and get started. Thank you for everybody who is attending today to this quarterly webinar, first one of the year. So the main items we're going to be focusing on today is some updates to Medicare, specifically Part B and Part D premiums, and then just some other general updates. I'll also be talking about some changes to Social Security limits, and then also some changes to retirement plan contribution limits. I thought this would be great timing since we are only 1 month into the new year. All right, first we're going to focus on a few updates to Medicare. All right, so there is a program. It's called the Medicare Prescription Payment Plan. And this is actually brand new as of last year. So basically, what this program does, instead of upfronting a large expense at the pharmacy, when you pick up your prescriptions, you can participate in this program and it actually will allow you to spread out those out-of-pocket prescription drug costs into monthly payments instead of one very large payment upfront at the pharmacy. So again, this came into effect last year. And to be eligible for this, you do have to have either a Medicare Part D drug plan or a Medicare Advantage plan with some type of drug coverage. So again, just specific towards the prescription plans. Since this is a newer program, there are just a couple changes for this year. So first, if you were enrolled in this program last year in 2025, you will automatically be re-enrolled unless you personally opt out. So previously, if you wanted to opt out, plan sponsors had to process that within about 24 hours. Now in 2026, that's been updated to 3 calendar days that they have to process that request. So if this is something you are interested in signing up for, you can just call your customer service number on your insurance ID card, or you can always visit your plan's website to sign up. You will have to complete a form. It's called the Medicare Prescription Payment Plan Participant Request Form. But other than that, it should be pretty simple to set up if this is something you're interested in. Continuing on with Part D coverage for Medicare, so there have been some updates to the out-of-pocket cost limits and then also the Part D deductible. So for 2026, the Part D out-of-pocket limit is going to be $2,100. Last year it was $2,000. And then the Part D deductible for this year is going to be $615. Last year it was $590. So a little bit of a raise there for both of those. Something that's important to keep in mind is that every prescription drug plan is going to have a different deductible. So your plan, the deductible might be lower than $615 this year, but Medicare just sets a maximum limit that no plan can exceed, hence the 615. So obviously you will normally pay 100% of those prescription costs until that deductible is met. And then once that's met, you'll pay a little bit of coinsurance up to that $2,100 limit. There has also been a change for a very specific type of Medicare Advantage plan. We also call Medicare Advantage Part C plans. And this change is specific to special supplemental benefits for the chronically ill. So these types of plans, it's basically extra coverage within a Part C or Medicare Advantage plan. And basically, this is for people who are, very sick on the verge of hospitalization. They have very severe and chronic conditions, so they can go out and seek very specific Medicare Advantage plans that might assist these individuals just with their daily life. So some examples of what these types of plans may help with are prepared meals, groceries, assistance with rent or the mortgage, companion care, transportation, things like that. So obviously not offered to everybody. But, there has been a pretty well-defined list of what these types of plans can help with. So the examples that I just gave. It wasn't until recently that the Center for Medicare and Medicaid Services specifically classified what is not included in these types of plans. So the examples I included I think are pretty self-explanatory. So, alcohol, tobacco, non-healthy foods, life insurance, hospital indemnity insurance, and then funeral planning and expenses are just a few examples of what these special types of plans will not offer. There's also been a minor update to insulin costs and how those are capped. So previously in 2025, insulin costs were capped at about $35 per month or less. But starting this year in 2026, Medicare is going to look at your insulin costs over the entire year instead of enforcing the limit strictly 1 month at a time. What's also nice about this is that no deductible should apply to insulin purchases. This is more of an administrative change, kind of on the back end. So it really shouldn't change the benefits too much from a dollar perspective, but it will help lower that overall cost for the entire year. Another update specifically relating to Part D coverage. Any Medicare beneficiary in the past has been eligible for very specific free vaccines, and that did start in 2023. But starting this year, that's actually going to be a permanent feature of Part D coverage going forward. So all deductibles and out-of-pocket costs are normally waived for specific vaccines. I included a few examples of what's a part of this permanent feature. So shingles, RSV, Tdap, MMR, there was many more vaccines on the list. But as a reminder, the vaccine list is reviewed and normally updated every single year. So the examples I just gave, might be different going into 2027 next year. And I'm also in a few slides going to cover changes to Medicare Part B premium, so that will be here in a little bit. But now we're going to jump gears and talk a little bit about retirement plan limit updates. So just a reminder, limits typically change about every single year. So if you are somebody who likes to max out your 401k at work or max out your IRA every year, maybe you do a monthly contribution to reach that maximum. Just a reminder that limits have changed, so you'll want to change your monthly contribution amount just to make sure that you reach that max by year end. So before I get into the limit changes, there is a pretty big change starting this year in 2026. So this is going to apply to retirement plans through work. So the most common ones I see are 401ks, 403bs, and 457s. So last year, if you made more than 145 grand in FICA wages, which is basically gross income, any catch-up contributions you make to your retirement plan at work will now automatically be treated as a Roth contribution. And you may not be familiar with what a catch-up contribution is. So how this works is you have your standard contribution limit of 24,500. That's the new amount for 2026. And then if you are above age 50, you're eligible for a special catch-up contribution, and you can put in an extra 8 grand into, your 401k or 403b. There's also a super catch-up contribution that's for ages 60 to 63. This is actually a new rule within the last couple of years, and that limit is 11,250. So as an employee, not including the employer's match, the most somebody could put in is about 43,750, if you are eligible for both types of catch up. Shifting gears, talking a little bit about traditional and Roth IRAs. So again, limits go up every single year. The new limit for 2026 is going to be $7,500. The catch up is going to be 1,100. So the most that you could potentially put in is $8,600. As a reminder, you can actually make prior year contributions to a traditional or Roth IRA up until April 15th. So, let's say last year you only put in 5 grand into an IRA and you're really wanting to max that out. You can make a contribution and mark it as a prior year, and it will go towards last year's limit, which was $7,000. So again, that deadline is April 15th, so the tax return deadline. Sticking with some changes to IRAs, first I want to talk a little bit about a Roth IRA income phase out. So what this means is once you reach a certain level of income, you're actually not allowed to contribute to Roth IRA accounts. So let's say you are a single filer, and you make under 153 grand, on the table here. Then, if that's the case, you can completely contribute to a Roth IRA, no problem. But if you make more than 168,000 as a single filer, you are completely phased out and you are not able to make Roth IRA contributions. And these income thresholds you see on these tables are based off MAGI, also called Modified Adjusted Gross Income. If you ever find yourself in between these income thresholds, like maybe maybe you're a single filer and you make 160 grand, that's your Maggie. If that's the case, you can do a partial Roth IRA contribution. But even though there are these types of limits, there is actually a way to get around this specific income phase out. And it's called a backdoor Roth contribution. Basically, how it works is you make a direct contribution to a traditional IRA. You want to make sure that you're making a non-deductible traditional IRA contribution. Once it is in that pre-tax IRA, you can then convert that contribution amount to a Roth IRA. So it is a way of indirectly contributing, but getting around these phase out limits. So yeah, that's a great strategy just for the high income earners who are subject to these phase outs. For married filing joint, that phase out is 242 grand to 252. And then for married filing separate, it is much lower at 0 to $10,000. There is also a special rule for traditional IRA contribution deductibility because again, a traditional IRA is going to be a pre-tax account. So really, this phase out only affects you if you are an active participant in your employer plan at work. So let's say you just contribute to your 401k and you also contribute to a traditional IRA. If you match those two criteria, then this phase out could potentially affect you. So let's say again, you are a single filer. If you make under 81 grand, you can contribute to your 401k, traditional IRA, and deduct your IRA contribution, no problem. If your income is over 91 grand as a single filer, you can still contribute to your 401k at work and your IRA, but if you're over that income threshold, you now lose the ability to deduct your IRA contribution. So, and it works similar to the Roth IRA phase out to where if you're kind of in between these income thresholds, you might get a partial deduction for your contribution, but you wouldn't get a full deduction. So last year, again, if you were a single filer last year, that range was 79 grand to 89 grand. This year it's 81 to 91. For married filing joint, it's 129,000 to 149. And then married filing separate stays the same at 0 to 10 grand. We have another limit here for simple IRA retirement plans. You don't see these types of plans too often. I mean, 401ks and 403bs are definitely more common, but typically simple plans are used by smaller employers. And the limits, the annual contribution limits, do vary depending on how many employees work for the company. So if you have less than 26 employees, the standard limit is 18,100. Catch up is 3850, and then the super catch up is 5250. And then if you have fewer than 100 employees, but more than 26, the standard is 17 grand. Catch up is going to be about 4,000. And then the super catch up is 50 to 50. So the total employee contribution for 100 or fewer employees is 26,250. And then for less than 26 employees, it's 27,200. So the limits are going to be, pretty similar across simple plans. All right, now we're kind of shifting gears and we're going to talk about Medicare Part B premiums kind of towards the end of this section. But I also wanted to highlight some updates to Social Security. So since we're already in February, you've probably already noticed these updates to your Social Security benefits if you are actively collecting benefits. But first, we'll talk about the cost of living adjustment. We also call it COLA for short. The COLA is basically just the inflationary adjustment. It happens every single year. So in 2026, it was 2.8%. Last year, it was 2.5%. If we look back over the last 20 years, on average, the annual COLA has been about 2.6. So the raise that everyone got this year was a little bit higher than that average. The 2.8% increase should add, on average, about 56 bucks per month to your Social Security benefit. And for the average retiree, that monthly benefit would be around $2,071. There has also been an update to something called the Social Security wage base. You may or may have not heard of this before, but essentially, while you are working, you do pay about 6.2% of your gross income to Social Security, basically Social Security tax for when you're retired. But that 6.2% only applies to a certain amount of income, also called the wage base. So in 2026, that base is 184,500. Last year it was 176,100. So just to give you an example, let's say somebody made 200 grand. Obviously, 184,500, you'd be taxed at 6.2%. But if you make 200 grand, that, 15, $16,000 difference, up to 200, you actually would not pay any Social Security tax on. So, it's a pretty high wage base, um, but it does change, every single year. So I'm sure next year it'll be close or maybe even in the 190s. There is also something called a Social Security earnings test. And there's a few criteria you have to meet for this to really affect you. So, number one, this might affect you if you are collecting Social Security benefits, if you're under full retirement age, which for most people that is age 67, sometimes 66. But the third criteria is if you are working while collecting benefits and while under that full retirement age. So, what Social Security does is there's only so much that you can make in earned income before Social Security starts to reduce your monthly benefits. So, in 2026, if you are under that full retirement age, you're collecting benefits, you're still working, if you make over $24,480, $1 is deducted for every $2 you earn above that limit. Now, the rules change a little bit for the year that you actually reach full retirement age. The limit goes up quite a bit. It goes up to 65,160. That's how much you can earn before this reduction would start. But if you go over that limit, $1 is deducted for every $3 earned above the annual limit. Now, once you actually reach full retirement age, which again is age 67, maybe 66, then you can work as much as you want and collect benefits, and there's not going to be any type of reduction. If you're curious what your full retirement age is, it will say on a Social Security benefit statement, it's just based on the year that you were born. And then circling back to a couple other updates specific to Medicare Part B premiums. So again, if you're on Medicare and you're collecting, Social Security, you probably already noticed this, but for 2026, that premium is going to be $202.90, which is about a 9.7% increase from last year. Last year it was 185. And then the Part B deductibles have also changed. So this year it is 283. Last year it was 257. I also included a chart below. So there is something called the income related monthly adjustment amount. We call it IRMA for short. And what IRMA is, it's basically a surtax that is added to your standard monthly premium for Medicare Part B and Part D as well. I just didn't include Part D in this table here. But a surtax is applied for higher income individuals. How this is determined is they will look at your tax return from 2 years ago. So, for example, your 2026 premiums are based on your 2024 income. So, if you are a single filer and make $109,000 or less, or if you are married filing joint, that limit is 218,000 or less. Then you just pay the standard Part B premium of $202.90. But you can see that as your income starts to go up, that Part B premium can get pretty expensive. Um, so just something to keep in mind when you're, planning for maybe how much income you might need in a given year, because some years you might need more than others if there are just some fairly large expenses that you're planning for. Um, if you're in a year where you know you're going to have a lot of expenses and maybe have some pretty large retirement withdrawals, definitely let your advisor know because we can help, work around that to help mitigate the surtax for this premium if that would even, be an issue for you. All right, so that summarizes all of the most important changes regarding the Social Security, tax, Medicare, and then retirement plan limits. As a reminder, if again you want to max out your retirement plans, make sure you adjust your monthly contribution amounts to reflect that since we're only in February. If you want to look into or read any previous blog posts, you can go to justupwealthmanagement.com, or you can scan the QR link here on the screen. If you want to receive these posts as soon as they come out every single month, you can also email your first and last name to inquiries@justupwealthmanagement.com to just automatically receive those posts. Or if you have any questions about this webinar, you can email inquiries@justupwealthmanagement.com as well. All right. Thank you, everybody, for attending.